Hey everybody, Lorenzo here. Today I want to talk about investment biases. These are the biases that we all have, whether we are aware of it or not, that are affecting our investment decisions. When it comes to investing, we should always use our sense of logic when it comes to our investment approach. Before deciding what to do with our money, whether it's for growth or safety of capital, we have to do our research. We have to do our due diligence and look at the facts in order to make a sound, rational decision. However, there's behavioral finance, which is basically the psychology of investing. And what they found that it's actually predictable and common for investors to behave irrationally. And this is because, whether we are aware of it or not, we all have emotional tendencies and biases that affect our decisions. And quite often, when investors make big mistakes and experience big losses, this is often due to a strong bias or emotional reaction. So today, I'd like to share with you the 4 common biases that I see working with clients. And by familiarizing yourself with these, hopefully it'll help you become more aware of the biases that affect your financial decisions. And number 1 is overconfidence. Overconfidence is the tendency to overestimate your predicting abilities, thinking that just because you made the right decisions in the past, that you're going to continue to have the same luck again in the future. Overconfidence can cause an investor to over-speculate or to over-invest and to neglect the necessary information needed to make a sound decision. And I'm going to use the example here of John. Now keep in mind that when I use these examples, although some of these are real-life examples, that have changed the names for privacy purposes. John has had a keen interest in trading stocks and recently decided to open his own investment portfolio with the stocks he chose. And after a few months, he sees that the stock he chose has gone up in value, has almost doubled. So he looks at this and sees that he's made the right decision. So what does he decide to do? He decides to invest more of his money. He takes the majority of his savings and invests it into these stocks. But what John doesn't realize that after a few months, these stocks have become overpriced. And neglecting these indicators, he decides to invest anyway. And after a few weeks of a continuous upward trend, the market corrects and the value of his stocks drop. And John not only erases the gains that he's made earlier, he loses a good chunk of his savings, more than what he was prepared for. So investors need to see the signs of overconfidence early. Achieving investment success is not just knowing when to invest, when to take advantage of an opportunity, but it's also knowing when to pump the brakes when the indicators arise. Number 2 is availability bias. Availability bias is a tendency to make decisions based on the stories and opinions that are relevant and readily available to us. This might be what we see in the news, what we see in social media, or stories and opinions that we hear from close family or friends. And since our environment shapes our perceptions and we naturally seek approval of others, availability bias has a big impact on our decisions. One example is Sarah. Sarah is a mutual fund investor, and she has friends who's been talking about cryptocurrencies. And they've been talking about how cryptocurrencies have generated a good short-term return for them, and it's overperformed mutual funds. And Sarah looks at her mutual funds, and she starts to feel the fear of missing out. So what she decides to do is to sell her mutual fund investments to purchase cryptocurrencies. But what she doesn't do is take the time to really understand how they work and the forces and the indicators that affect the investments. So she invests blindly. And after a few months, the upward trend continues, and unfavorable news was released that affected the price of cryptocurrencies, and the value of her investments plummet, and she lost more than what she was prepared for. So when hearing about investment opportunities from any source, investors have to take the time to analyze and do their research and try to decipher what is a good investment opportunity versus what is pure hype. And just because you hear about it a lot or your friends are doing it shouldn't give you enough of a reason to invest. Number 3 is endowment. Endowment is a tendency to overvalue a particular asset that you own versus the ones that you don't own. And this is often due to a special sentiment or emotional significance with that particular asset. And this can cause an investor to overinvest or to hang on to that particular asset even when it doesn't meet their financial goals anymore. An example is William. William's grandfather recently passed away and left him as a beneficiary of his estate, which included a little bit of cash as an inheritance and also a few rental properties. And William had a close relationship with his grandfather, and he really admired the fact that he had become wealthy and did it through real estate. So he decided he was going to follow his grandfather's footsteps and build his own real estate empire with his inheritance. And so he goes out and he starts purchasing in properties, rental properties, just like his grandfather did. But he becomes so set in building his empire and becoming like his grandfather, he doesn't take the time to analyze these properties that he's getting into. And after a few years, maintenance costs of these properties has gone up, and the stress that comes with managing these properties had become a burden for William. Buying or holding on to things because of the emotional value that it gives you is different from investing with the intention of making a profit or for safety. When investing, it's best to put aside these emotional sentiments in order to have a more realistic view of the opportunity to see if it really suits your goals. And the fourth one is regret aversion. Regret aversion is delaying or putting off making decisions due to a fear of a loss, even when the signs indicate that it's a good time to invest. And this often stems from a past experience of a loss, causing an investor to be overly cautious. Although some investors are conservative and prudent, putting off decisions or overanalyzing can lead you to miss out on great investment opportunities. And this can compromise your ability to reach your financial goals. Now, one example of this is Mary. Now, Mary, prior to 2008, had a good amount of her portfolio invested into equity mutual funds. And when the financial crisis caused the markets to collapse, she loses a good chunk of her portfolio. And she was devastated. And devastated by this loss, she moves all her equity investments into GICs, into cash-like investments. She didn't want to take any more risk and decided that she was just going to keep her investments safe. But afterwards, after the stock market crash, her financial advisor had actually advised her to go back into investing into equity mutual funds because it was a good time for her to take advantage of depressed stock prices. But all she can remember was this loss that she had. So regret aversion caused her to delay making any decisions. Fast forward a few years, the market started to recover. And it's now 2018, 10 years from 2008. If Mary had taken the opportunity to invest earlier, when her financial advisor had told her to, she would have recovered from her loss and have even more than what she had before. Now, I know no one likes to make the wrong decisions and to lose money. However, if there's a gap between where you are right now and to where your financial goal is, you have to make decisions along the way and take advantage of opportunities when they arise and to protect your money when needed. So your approach to investing always has to come with a sense of confidence. And the only way to alleviate fear or to halt over speculation is to educate yourself and take the time to get to know your financial goals, your preferences, and also your own biases. The more you educate yourself and the more aware you are of your own biases, the more likely you are to make rational decisions for your own greater good. And that's it for this video. Hopefully, by hearing these biases will help you become more aware of any biases that you might have. And if you have any questions at all about these biases or need help making any investment decisions, feel free to give me a call, feel free to shoot me an email. And thanks guys for tuning in. I'll see you guys next time.